You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 26th of March, 2026, and I'm joined by special guest Joe Kaye. Joe has been on before twice, and I will post the previous interviews prior to this episode for anyone who does want to go back and listen to them. We do have our normal disclaimer at the beginning that we're not financial advisors and nothing we say is financial advice. Now, Joe actually is a financial advisor. However, nothing he says on this podcast is financial advice. If you would like financial advice, you can get in touch with him. But everything he says on this podcast is not financial advice, just to be very, very clear on that. So, Joe, thank you very much for coming back on the show.
Thanks for having me again, Sam. Great to be here.
I think you last came on, I guess it was around 11 months ago, actually. I'm not sure. But anyway, around a year ago. So how's the last year gone for you?
Yeah, very well. Quite full on, taking over the family and IFA business, the financial advice business. So I'm 2 years into that. So the second year has been a good learning curve and getting up to speed. And then I've also had a very successful investment year. And on top of that, just had my second child as well. So it's a lot going on, but all good stuff.
So if we start with, well, firstly, congratulations on the second child. I'll start with that, actually.
Thank you.
If we move on to the investing side, could you talk about what your returns have been like? But then as well, when we last caught up, you'd kind of recently pivoted away from kind of, I think, special situations to more kind of, I guess, higher quality stuff. How's that kind of pivot gone? And how do you feel about that, having had an extra year following that decision?
Yeah, that's right. Yeah, so it's been 2 years ago since I modified my strategy to move away from special situations and more into quality, growth, and value, I suppose, is the way that I classify it, but still fundamental investing. And one of the main reasons why I decided to move more in that direction, I still do some special situations, is that I was finding from a time management point of view, it's easier to put a concentrated portfolio into high quality businesses with great management and leave it to run for a good long time, rather than with special situations. There's a lot of turning over new ideas. So when an idea plays out or doesn't play out, then you have to move on and find the next one. And that's quite time intensive. So that was the main reason for the switch. But also, I suppose the other underlying reason was that I had some very positive experiences going for businesses that with great high insider ownership and really, really well-run businesses, instead of kind of the businesses that have issues and management isn't great, but it's very cheap, or that kind of thing. Still managing to find cheap businesses, but much better quality of business. And that's had quite a big impact on the returns. So I manage my own portfolio, and then I also have a discretionary management strategy, which is called Special Situations Global Equities, and they are echo each other. And I use the research from my personal portfolio to overlap with the fund or the investment strategy. But I kind of do a bit more aggressive on my own personal portfolio, and then a bit more defensive. It's still pretty aggressive strategy, very concentrated in the Special Situations fund. And so the returns are kind of different. And I don't know if I should really be talking exactly about returns because they're not like audited or anything. But yeah, so like in the last 2 years...
If we just assume it's a ballpark figure, no one's expecting a quote.
Yeah, in the last 2 years, so the year before last, I think it was nearly 150% personally. And then the following year was like just over 100%. Absolutely insane. I didn't expect to get that good returns. And then the fund has done 50% each of those 2 years. So 50% a year for the 2 years each year. I think that actually the first year it did 60% and then it did 50% the second year since the change in strategy.
When you do take on a new client for the fund, you're kind of managing an individual account for them.
Yeah.
Have you ever looked at having like an actual open-ended fund where someone just buys units in it, or is that too expensive or too complicated? Oh, okay.
That's my next stepping stone. So I have been looking at a UCITS fund or something similar. So then I can set it up myself, and I've spoken to a couple of firms about setting that up for me. But that was just before I had my second child, and since then I haven't come back to it. But it's something that I have in mind, and that will be much easier for people to buy into. And then also, at the moment, I'm managing individual clients, and they've got general investment accounts, ISAs and SIPs and whatever. If they've got just a general investment account, then the capital gains I'm realizing in that account are obviously taxable. Whereas if it's in a UCITS fund, then the turnover or the buying and selling isn't taxable inside the fund. So that would be a big benefit of doing that. And then I could obviously put all my savings into that, and kind of it would roll up without tax, which would be very nice.
Is there a certain size the fund would need to be for that to be feasible, or could someone do that on day one and just hope people invest?
Yeah, so the guys that I was talking with, they said that I'd need to start with I'd need to kind of start with about 10 million and then work up towards 20 million as a kind of bare minimum over the next 2 years from opening it. And then from there, then it kind of just grows. You really need to kind of have 10 million as the bare minimum starting point. Otherwise,
Right.
the costs don't really add up.
So if you had the 10 million, what would the cost be looking like as a percentage for the investors? Would it be a sort of standard 1 or 2%?
Yeah, it would just be like a managed fund, normal managed fund charge.
Right. If you wanted to do it with, say, 1 million, you could still do it, but the cost would just be ridiculous as a percent. Or would they just say, no, go away?
Yeah, I don't think they'd want to launch something like that.
Okay. Okay, that's interesting. So then, could you talk a bit about then expanding on the differences between your own portfolio and the funds?
Yeah, sometimes I just take a larger asset allocation on things that I think have potentially more on the risky side but have a higher return. So then I give the fund a lower allocation to that, just a bit more sensible, I guess. And then I also kind of just sometimes mess around with things that aren't in the fund. But actually, that hasn't been very profitable for me. I'm better off just sticking to my core strategy. But I like to kind of learn about options and how to use them, which I'm still not great at. But yeah, I just think that might pay off one day.
Where do you go then a lot of the time to actually find a lot of these companies? Because a lot of them aren't even UK listed. They're very, very small. I guess if you to compare them to, say, a normal stock we'd cover on the show, which typically tends to be FTSE 350, and they tend to, not tend to, but quite a few of them are in countries that, again, I would never even think to look at. So where do you actually start with finding some of these?
Yeah, so I have a global screener, which is kind of a modified Joel Greenblatt magic formula, but it's very detailed and it has extra bits to look at the smoothness of the returns over the years, over the last 5 years, which I think is a really big addition to the process. And some other things looking at the kind of quality of the business and but then obviously the return on invested capital and the earnings yield as the core drivers for the screener. So I download the data, then I modify it in an Excel spreadsheet, and then I produce a score. Is it normally get about 5 to 10,000 global stocks, and then score them, and then just go through with the ones with the highest scores, and just one by one, and that really throws up a lot of just awful stuff that you just have to get rid of straight away. And the idea is to just kill the idea as quickly as you can, and then come back. Then I just highlight rows that I'm interested in and come back to them. And normally after like maybe a 6-hour session, I end up with 3 or 4 that I'm interested in. And then I will go back and look at them and try and kill those ideas as quickly as possible. But if I can't manage to kill them quickly, then I will go really deep into what they do and why they're so cheap. Like, that's normally the first question, is why are they so cheap? And if you can't answer that easily, then you think, oh, maybe the market's mispricing it. But it tends to, 2 years ago, it was flagging a lot of equities in Israel, and I guess that was because of the war. So that, it's just kind of, it brings up areas that you would think, oh, maybe I shouldn't be investing there. But then you happen to find some incredible bargains there just because they've been too sold off, or there's interesting stuff going on there. And then a year later, I did running the same screen, loads of Japanese stuff. So it kind of it's strange how it brings up certain geographies that are being a bit overlooked. And then you just find things that literally no one else is talking about because you're just going through a list that, no one said, oh, you've never heard anyone on X talking about it. But then that also kind of makes it quite difficult to research because you don't have any other views on it. There's no analyst coverage on a lot of these. I'm kind of looking between 50 million and, well, up to 1 billion, I guess. So it is quite a wide range, but I'm finding between 50 million and 300 million is kind of the sweet spots for me. And I just find things that, like Qualital was just insanely cheap. And it was priced at like, I think 5 or 6 times EBIT, but it wasn't pricing in the massive growth. They were growing super quick. And it's just like, it shouldn't have been valued at that valuation at all. Then 2 years later, it's up like 10 times. But I was just looking and I was thinking, what am I missing? Why is it so cheap? It shouldn't be that cheap. You're getting the growth for free. It's a really high quality business, great management, insider ownership, loads of cash on the balance sheet. There was literally nothing wrong with it at all. And it was in a massive growth in sector because it was testing semiconductors. So it was just like their TAM was massively expanding and they're just huge tailwind. So it's like, what am I missing here? And that's the tough part when you're on your own and no one else is covering it. You've just got to really go deep into the company and get comfortable with it. And then again, like running the screen a year later, kind of found Santec, which is they do tunable lasers and they also do fiber optics testing equipment and stuff like that. And I thought that's got a big tailwind, but it was also that was trading about 6 times, big growth. It was in a bit of a cyclical low with one of its segments, but that looked like it was going to come back eventually, which obviously massively has now. And it's just crazy that you can find such high quality businesses. You just see like so it had like operating margins of 30% and steady growth of like, I think more than 30% each year. Like just the graph is just like straight up, super consistent. It's not like any like, and I think that's one of the things that the screen flags is that instead of having like big peaks and troughs in your earnings, it has that quite consistent increase in earnings, which I think is a sign of a high quality business.
So there were there was a lot of interesting stuff in there, but there were a few that I'd like to go in a bit deeper on. So you talked about the scoring. When you say you score it, where does that score actually? I'm assuming with the number of companies, that is just a completely kind of formulaic almost.
Yeah, it's just a rank.
So how is that rank arrived at? What does it actually look at?
The core components are the same that go into the magic formula, which is that, like really corny name for a really good screen. But it basically, the magic formula just says there's 2 metrics, there's 2 key metrics, the return on invested capital and the earnings yield, which is, I think, EV/EBIT.
Right.
So just like based on those 2, the best, and then it will just rank them with the highest. It will take an average between the 2. I think it just averages the 2. Sometimes I do average of the 2. Sometimes I favor a bit more the quality or sometimes value, but like it's those 2 core things that can determine the rank.
Right. And then could you expand on killing the idea? And I think it's fairly obvious what it is, but I think it's a very sort of, I like the phrase and it's obviously a very key concept, so I think it's worth diving into.
Yeah, I borrowed the idea, I can't remember who, some famous investors always says killing the idea, but it's a good one because it's literally, you want to move on to the next idea. So you don't want to waste time on something that you want to go on to the next idea, and killing it quickly means looking for things like any mention of fraud, just kill it. Dodgy dealings of management, kill it. Or, is in a sector that is completely unfavorable or you're very uncertain about, just kill it. Or it's got like super, not a long track record, or, like a very new product, or, in a disruptive industry, just, these are things that you can just quickly go, no. Or is it even in a country that you're not keen on at the moment for some reason? I don't know. But there's lots of reasons to kill a company and move on.
Okay. And then the final thing that come from that is you said there's this sweet spot of probably between, I think you said 50 to 300 million. If you say the fund goes well and you do shortly end up with your open-ended fund that doesn't cost too much to run, do you think there's a market cap for that fund? Well, there obviously is, but in terms of the fund getting to a size where some of the ideas that you really like at the minute you maybe can't buy because you just can't build up a position.
Yeah.
Or if you kind of focused on 50 to, because those are not small companies, if it's 50 to 300 million, is that just so far down the line that you wouldn't really need to worry about it for a long, long time?
I think for quite a while you wouldn't need to worry about it. My largest holding at the moment is Tabela Systems, and they're a small Japanese company. I bought them when they were a market cap of about 50 million, and I think the EV was like 30 million or something. Is quite a small, like they had a lot of cash on the balance sheet. So at 50 million, I was buying it, and then I found out later on that Dan Smokes of Smoke Capital, he already had built up a big position. He'd been buying it all year. It took him a year to build it, but he's running a fund that's, I don't know, 50 to 100 million. I'm not sure how much he's got under management, but he has built up a really big position. He now owns 7% of that company, even though he was buying it when it was a 50 million or less market cap. So it is possible to do that, but you have to have, he's had a lot of meetings with management and just got really, really comfortable with the business and why it's so cheap. So he's managed to take that big stake. But again, like that's not, it's still probably not even a 10% position for him. So it will start getting more difficult to get exposure to those smaller companies. But I think, you could easily have access to the 150 to 300 million for a long time. And that is still an area that's very overlooked by the market. There's very few people looking at that.
Why do you think that is? Is it just because of sort of media coverage and then the bigger funds that most people are kind of following, it's just not on there, it's not in their investable universe?
Well, it's the same reason as what we're talking about with 50 million being out of my range. If I got to 50 million under management, most of the funds have a lot more than 50 million under management. So it just wouldn't move the needle for them to look at 100 million market cap.
Right.
Or 150. It's not worth their while. A lot of funds are, kind of a billion plus. There are some smaller funds like me that are looking at things, and that's why, you do get these small undiscovered things, and then suddenly people are talking about them on X because someone has gone public and said, I've put together all the research, and then the discovery process happens quite quickly, and it re-rates quicker than otherwise it would have, because someone who's got a social media presence, I guess, has alerted people to the fact of the story, and then people have bought into then it's got more views, I guess. Like what just happened with the special situation that I bought into today. It's 100 million market cap. It was like 50 million quite recently, but the pitch was so good and so easy to follow and easy to understand why it's so cheap that today it's normally trades about 30,000 shares, and today it's traded about 150,000, just because it's got very popular all of a sudden.
So if we switch to your other job then, so you're working in the family IFA business. It's your second year. How's that compared to your first year?
Yeah, it's great because I'm doing more client-facing work, and I've got up to speed with the presentation of the material and really starting to put together all the material for my cases and go quite in depth into the research and the presentational side of it, which is, I suppose, the presentational side is something that's kind of new for me, being kind of quite a mathematical type person, studying maths and then doing actuarial. I'm used to presenting numbers, but having the whole story behind why you need to do things and explaining it in quite a wordy way is a new thing for me. That's a kind of a new challenge, which is enjoyable.
So last year you were saying, I think the issue your dad had for a while was basic capacity. So he was quite happy with the level it was at. He didn't really have capacity to take on more clients. So it was a good firm, but it wasn't growing, albeit by choice. And then since then, obviously, you've come in and then now there's some capacity, so it started growing. And I think you were either about to, or you'd just taken on your brother as well.
That's right.
So how is it going in terms of sort of acquiring clients? Are you still out acquiring them? How have you found it? Are you getting to a point where you're starting to reach capacity?
Yeah, that's a great question. Yeah, so we did actually take on my brother as well. So we created enough capacity to do that. Created enough workflow to do that, and he's been great. He's been really, really good, and he's studying for the financial advice exams as well. So he'll be able to increase capacity further once he qualifies. And we've said to existing clients, we're open for referrals now. So if you do think of anyone, let us know. And that has produced some really big, really nice clients. So that has immediately worked. And then we've also got partnerships elsewhere who are starting to feed in new clients as well. So we're kind of focusing more on the higher net worth clients, I suppose, like 500k plus of assets under management or investable assets. But we're getting quite a few that are over the million mark, which is kind of where we want to be, because we can do the most interesting stuff for them, and we can look after all clients, but that's kind of where we're aiming for in terms of market. And I'm still not in a rush to build up the business. I like being able to have a bit more time to do things, and actually also reorganize the business and modernize it to get it into a place where it's easier to run. So I'm also like looking at AI solutions and other tech solutions to modernize the business. And then I think that will facilitate much more capacity and easy to run business in the future.
Do you use AI much? Because I mean, just in terms of my own job for tax advisory, I mean, I'm finding now I'm using it a lot. You've got to be super, super careful with it. But I just find it so much easier to just find sources as well, easier than kind of you relying on Google. So even stuff like, I know it's not as relevant for like what you're doing, but like a lot of the time it's like we'll refer to HMRC manuals a lot in terms of the advice, and you actually find that AI is really good for just trawling through the manuals and just pulling out something on a subject that you want in, rather than you having to sort of go through the manuals based on the contents page and sort of find this. It's a lot of stuff like that. But yeah, I mean, just sort of drafting sort of the body of emails sometimes, assuming there's no personal data in it.
Mm-hmm.
Like I was doing it today, and it was like we had to review an SPA for sale of a business. And because so much of what's in the SPA is just kind of legal speak, because they'll just have their definitions at the beginning, and then everything else it will just refer to the seller, the buyer. You can put quite significant chunks of that in and just say, well, what does this mean in plain English? What are the kind of the pitfall? And again, you do have to actually have that understanding to be able to go through it yourself and read it and understand it, rather than just relying on it. But as a tool, some of sort of the comments and thoughts it will just flush out. I just find it amazing. But I'm just wondering what your experience is in a similar but slightly different industry.
Yeah, I equally find it amazing. And yeah, I think you're right to say, like, you have to be really careful with the data and make sure that there's no personal information going into the AI. So super careful about that. And also we do our Teams meetings with AI, which is recorded.
Then it takes notes, or
yeah, and then it takes really good meeting notes, like really good summaries, but also like the transcription's useful as well. So sometimes where the summary doesn't fully capture it, you can ask in a chat to query the transcript and say, did they mention this about, find me the section that mentions exactly how much they were saying about this pension or whatever.
Are you using that for internal meetings or client meetings?
Both.
Okay. What do you find then in terms of, because obviously the clients, I mean, they're going to be told at the start of the meeting. Have you had anyone push back on it, or is everyone just pretty relaxed?
Yeah, one or two. I think particularly newer clients. I suppose there's been one new client that said, I prefer not to record it, and that's absolutely fine. We just say meeting notes the manual way. But most people are absolutely fine. We just say we're using it for internal purposes. It doesn't go anywhere, and it's completely secure. Yeah, that's been really, really helpful, and it's good for a compliance point of view, tracking for our records. And then, just like you say, like helping structure some of the wordings. I find that helpful. Well, sometimes it's not that great, but it's a bit hit and miss at the moment.
Yeah, it is. But I mean, sometimes it's like mean, again, it's like we had one recently where we had an inquiry with HMRC, and it was on like a BPR claim, and we'd been through like 3 rounds of information gathering with HMRC, and it got to this, which they're not meant to do, but it got to the stage where it just felt like, because they started then in the 4th round asking for stuff that they actually already had, but I think they maybe didn't actually understand the position well enough, so they maybe didn't appreciate they had it. So again, it's like you can draft this email where you sort of basically I've drafted this email and just plugged in the body of it, and it's just like, make this more aggressive. And I think stuff like that is really good for.
Yeah, it's really good for that. And also actually for general, so I filled out my self-assessment for the first time last year, because I always got the accountant to do it before, but then I switched accountants, and I just thought I had a particularly complicated self-assessment last tax year. And I was just taking screenshots of the self-assessment and then giving it to AI and saying, what are they actually asking for here? What do I need to put? And it was coming back with like really good, helping me do that.
Right, HMRC, just as an aside, they do actually. Do you use the notes for it?
Yeah,
because they're quite useful.
Yeah, they are. But there was some that I was just like, I just don't know what to do here. I don't know what they're asking for. And then AI just explains it so well.
Yeah,
it's really good for like that kind of standardized forms, helping you fill that kind of thing out.
What are you doing then in the firm in terms of deciding which staff members do and don't use AI and how much? Because I find with the AI, like I say, it's really, really useful, but you've got to know how to use it properly, and you've got to understand the subject yourself, because otherwise you're not going to sort of flush out the hallucinations.
That's right, yeah.
So, I mean, my view is, like, for example, a trainee someone who's not qualified shouldn't be using it, is my view. Until you get to the point where you've passed all your exams and you're qualified, I think you've got to build up that skill set of learning to do it yourself. And then at that point, once you've got all the technical knowledge, you should hopefully be in a position where actually you can then start using the AI to help. I don't know if you have a different view or if you've got a policy on it. Or
Well, my brother's training to be an IFA, and he's building up his knowledge, but he is fantastic with AI, and he's producing really, really good stuff and some very technical calculations with the help of AI, and they help explain it. So when he's not sure about why the calculations are like that, you could just query it and it will give you more background. So it's actually helping him learn. And then obviously we check his workings. And then we've got our technical team as well, who check. We have an outsourced technical team, 360, who are fantastic. We can just call them up or share documents or whatever, and they will review any documents that we want. So I think AI is a fantastic learning tool, and being able to give access to someone who doesn't have the full knowledge but knows kind of has been set a task of like calculate the IHT liability for this, then they can kind of go down a train. But I agree with you, like that you get the best results if you know exactly what you want, and you'll know when it's kind of lying to you.
Yeah.
So it's a fine balance.
Yeah, I find like one example is like if I'm doing something with the AI and I might ask it to find me a specific bit of legislation, or if I'm asking something and I don't know what bit of legislation I want and it quotes the legislation, I find a lot of the time if you actually go into that bit of legislation it's quoted, it's possibly quoted the right legislation but given the wrong sort of reference. Or it's quoted a section of the legislation that often doesn't exist. And that's one of the things it's particularly bad at. And you might have to go for a few rounds before you actually get the legislation. Whereas like with a trainee, 9 times out of 10, I think if they were using AI and it quoted legislation for them and said it's, IHTA 1984, section 104, I think a lot of the time they wouldn't then go and check because they'd think there's a quote.
Yeah.
And they'd just kind of copy and paste that. And that's why I just find with the trainees, I think it takes a while to sort of develop that, actually sort of check. Because almost I think a lot of the time this may be more unique to tax trainees, but I think in the first few years, you're almost trying to do the work to get it past the reviewer. And then you kind of get to a stage where actually you're doing the work because it's going to a client and it needs to be right, rather than just how can I get this past the reviewer so that I can just move on to the next thing.
Yeah,
I think it takes a while to build that mentality. It's probably not the same for like your brother in a family business because he is just by nature kind of more invested in it.
Yeah.
But I do find with trainees, it does take a while to build that up.
Yeah. I think you need to do it yourself first, really, to learn it. Yeah, that makes sense. But I would say like I also use AI a lot for getting up to speed on investment ideas. So I'll ask it to do a prompt for a specific company and go into it in depth into, if I thought that there was some issue with the company or something, like, or something on the balance sheet that I didn't understand. I'd go in quite in depth with that, with AI, and that would be really good. And then what I could do is also I use like three different AIs and then get them to check each other. So that's also quite helpful to see if there are any discrepancies or different points of view. Yeah, so using different AIs to check AI output is quite good as well.
Is there one that you find particularly good?
I have the paid ChatGPT, which is very good for a lot of things. And then especially on like the thinking mode and the deep research mode for like calculations and that kind of thing. And then I find generally Gemini very, very good for most things, probably better in lots of ways. But I don't have a paid version of that. Probably should get a paid version. And then I think I haven't used Grok so much, and I sometimes use, what was it? The other one? Claude.
Okay.
Yeah.
I find Perplexity works best for.
Okay.
But then at work we're not allowed to use Perplexity, so I end up using the Google one, which I'm assuming the one that's now built into the Google search bar must be Gemini.
Yeah.
So. Which is it's okay. It's okay, but I don't find it quite as good as Perplexity. But then the Perplexity I've got is Perplexity Pro, so it's not really a fair comparison.
Yeah, because there's different settings, isn't there? For like you put them on thinking or thinking longer or all that kind of stuff.
I'm not that advanced with it.
Okay.
I'm sure if someone who really knew what they were doing with AI saw the way I was using it, I'm sure they'd be like, "You've not really scratched the surface." But
I think that is quite an important thing, though. With if you just use AI and it's like basic mode, it's really bad at calculations and logic. Mm-hmm. But you have to set it into like the thinking mode or the long thinking mode for it to actually get good at calculations.
I think that runs different AIs in the background and then takes the best answers. So I'm hoping that means I don't need to bother.
That one probably does it for you yourself. But I think with Gemini and ChatGPT, they definitely have different modes that you can set it in, and they're absolutely rubbish if you don't set them for calculations, if you don't set them on thinking mode.
Right. That's interesting. So obviously you're enjoying the IFA business, you're enjoying the fund, and basically working 2 full-time jobs as well as having 2 young children. What would happen then if the fund did get to a certain size where you could just do it full-time and do very, very well from it? Would you still want to do the IFA, or do you know what I mean? Say the fund got to a point where you're managing a £50 million fund.
Yeah.
At what point do you think you would kind of switch to just doing the fund, or would you not see yourself ever doing that?
I don't know. I think it is changing a lot. I mean, I'm earning a lot more from the investment returns that I'm getting than the IFA business. That is on a different scale. But I think that the IFA business really gives me a lot personally. It's very fulfilling because I really enjoy helping people face to face. And I think the combination of the two is great. I think that probably I get to a place where I would have just more of the IFA work that I really enjoy, just the client and the strategic thinking work, and then less of everything else. And then I would just work with my brother to manage it, and then we'd probably bring on another IFA, and then we could.
That's why brothers.
No, I've got a sister, but I don't think she's going to be interested. But yeah, so just I think I kind of want to keep it small, but then have like really high quality business and really great people to work with, and I have that fulfilling side of helping people. And also I think that complements investing quite well, because with a lot of things you kind of have to sit on your hands with investing. You invest and then you can continue doing research, but there's a tendency to want to do trading or something like that, and sitting on your hands is quite difficult. But if I keep my hands busy helping with the IFA business, then that kind of helps that process.
What do you think then your ideal balance would look like? So would you be doing a few days a week, rocking up for meetings, doing kind of big picture stuff, and then just kind of working with clients that you really, really like working with? Would it be something different, or
I think probably in an ideal world, like in a good few years' time, I'd have my brother and maybe someone else managing a lot of the business, and then I would be dipping in and out of meetings and looking at some more strategic side of the business as like maybe 25% of my time. And then 75% would be kind of investment fund focused. That I mean, just out of thin air, that sounds like that would be the ideal for me. But I have no idea. You just have to kind of see once you get there.
Are you allowed to put clients in your own fund, or would you not do that? Or have you had any that have asked? Or because they must know that you do this. You've got this sort of almost side project of the fund.
Yeah, so I don't tend to mention it to most clients, but there are a few kind of high net worth clients that I know they want something a bit more interesting and a potential for higher returns, but they have the risk capacity and the capacity for loss that makes it comfortable for them. So they might put in a bit of their own money, a bit of their savings into it, not all of it. And so I have offered it to a couple of IFA clients, and with the very, upfront disclosure about it being high risk, it's 10 out of 10 risk.
Yeah.
And, it's for the long term, and with a small portion of their overall savings and that kind of understanding. And yeah, that has been very popular with a few clients, and especially some of these newer clients that are high net worth. They like the idea of that. And I have to list it as, a conflict of interest in the register internally. And it's just, I have to justify that it's what the client wants, and there isn't anything else equivalent that could be offered and that kind of thing. So it's covered on the compliance side.
Right. So you can mention it then for the right clients. Oh, that's good.
Yeah. And it might be that we can do something, set up something for all clients in a small way, which is, when I was setting up this fund, I had the thought in the back of my mind that we could potentially do some kind of arrangement for all clients with a very small proportion. And yeah, we'll see where that goes. But there is, certain compliance issues that I have to deal with, obviously. And there's just a lot of setup and but it is something that's interesting and could work.
Okay. You still doing the yoga?
Yeah.
Mindfulness. Oh, good.
Yeah.
How's that going? Are you more flexible?
I am actually, yeah. It's great. It's slow. Progress is really slow, but it's good. Yeah, I'm feeling like very good in my body and like, best I've ever felt really since I was like 18. So, it's really nice to have that flexibility coming back, especially with kids. Like sitting on the floor isn't an issue anymore and that kind of thing. So, but it's also just had a massive impact on my mental stability and strength there, which is really nice. Not just for investing, I think it's absolutely key, but also just for the rest of your life. Like just being able to handle things that used to annoy me all the time. It just makes life easier and more relaxing and more enjoyable. So it's kind of, for me, it's been a big transformation over the last 2 or 3 years to really get to a great place mentally, where I'm just kind of getting more and more happy in myself.
So how often are you doing that a week, and for how long?
So I was doing yoga like every morning, and then I kind of got out of it, but every other day, kind of some kind of stretching yoga type thing, physically. And then every evening I do meditation before sleep, which is great. It really helps sleep, actually, and the quality.
I didn't know you slept.
Yeah, so the meditation is, also it's not just meditation, it's also like mindfulness and just being aware of the present and bring yourself back into the present. You can just do that on a walk or anytime, even in the car, stuck in traffic, just any excuse. You can go like, wow, this is pretty amazing that I'm here. Like you can find anything to be grateful for, like beautiful view or enjoying music or whatever. You can't be worried or angry when you're feeling grateful. Like when you're feeling grateful, there's all the other like bad emotions just disappear basically, which is cool.
I don't know if there's anything else you'd like to cover before we wrap it up.
One of the things that I'd say is that's driven the really good returns that I've had, like insanely good, is being very concentrated in things that have done very well. And I know that sounds a bit silly, but like if I can find something that is genuinely low downside risk, it means that I can take a really big position in it. And if you can find something that's low downside but has really big growth potential, doesn't mean that you're paying for the growth, because you shouldn't be. If it's low downside, you'll have low valuation. But if that growth materializes and you've got a very large amount in there, then that can massively impact the returns. So I think I have a more unique approach to investing than others in the sense of like concentration. So when I find something that's really low downside, like Qualital, with like huge amount of cash on the balance sheet, low valuation and big growth, I actually went 30%, which is my maximum, into that. And then I trimmed it as it went up, but it went up 10 times, or actually it went up 500% until I sold most of my holdings. But it kind of doubled and it became a huge portion of my portfolio. And then I trimmed it, and then it kind of doubled again, and then I trimmed it. But that has a massive impact on the returns. And same with Samtec. That was another one that I felt had low downside. Again, I went 30% initially and then trimmed. I don't really see people talking about doing a very big upfront concentration and then trimming as it goes up. And I think there's a lot of like the hold forever type mentality, which I don't like, because I think that at each time point you should be managing your downside risk. And once something that's got very big as a portion of your portfolio, it can affect the way that you think about it and the way that you act, and it might not even be the best risk reward anymore. So it's kind of just, I like that balance of managing the risk reward at all points. So just taking chips off the table when things have done well, but going concentrated at the beginning where the risk reward is the best, I really like that strategy.
I think there's a bit less never sell than there was a few years ago now. That does seem to have tailed off a little bit. I think probably the COVID high. I think that was probably the height of don't sell.
Yes. Well, the top bull markets is always confirmation bias. Like that's the key driver there, is confirmation bias, is like, looking for anything to keep you still invested. Having done so well already, you just think it's going to continue.
Do you find much of that then as well, just as a final question? Do you find much of that on the IFA side with clients and their behaviours? Or are most of them quite happy to just leave you to it?
Yeah. Clients want to know to varying degrees about the investing, but they're just not as interested in the underlying investments as you or I that kind of look at balance sheets and stuff. So it's just more that they're looking for long-term returns and steady, low volatility stuff.
So you wouldn't, for example, then when it all kicked off with Iran, was your phone ringing off the hook? Or...
No, not at all.
Oh, wow, that's surprising.
No, we haven't got a single phone call about that.
Oh, wow.
So clients just like even so in the COVID lows, or when COVID was happening, that was the point where we'd contact clients and we'd say weekly with an update of where we are and what we're thinking, and just to kind of remain calm and whatever, just explain the thought process. But like that's in a proper crash. But even with the tariff crisis that we had last year, we explained it in reports, the volatility, but it bounced back quite quickly. So
yeah, it did.
Eventually the rest of the year didn't really need to explain that much. And clients just it just doesn't move the needle much for clients because it's so well diversified and has a good amount of fixed income in some of the portfolios. Yeah, it's just well diversified. So you just don't get that volatility that would scare them.
Right. Okay.
Yeah.
Right. I think that really is everything on my side. Yeah. Unless there's anything else you'd like to add in before we wrap it up.
That's great.
Right.
Thanks very much.
So if someone wants to get in touch with you because they do want financial advice, or if they're interested on the fund side, where can they contact you?
jkpm.co.uk. And on the fund side, you could probably just contact me on X or through the IFA business. It's my handle on X is Joe Value, and I also have a Substack as well if you want to read any of the research notes that I've produced there. And that's also that's actually, you can get that from my X handle, like in the bio there. So
that's everything in that case. Thank you very much for coming back on, and I'm sure we will have you on again soon.
Thanks very much, Sam.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.